Can you hear me well?
Yes, from my side.
All right. So, students, we discussed in the last session the concept of assurance engagement. We have discussed that, and I told you that revise it well before next class. And I'm expecting that you people have done it well already. Means you have revised it the last lecture. Today, we are starting with the regulation of audit. And after regulation of audit, we will be proceeding towards ACCA Study Hub to do some objective test question on the same. This volume 2 of the notes I have already sent to you people over here. So let us proceed and talk about the regulation of audit. Regulation of audit. Now, what the regulation of audit is? Regulation means clearly to direct, to control, to monitor, and even in some circumstances, of course, penalize as well if they don't follow direction. So regulation is all about that. You are regulating their behavior, their attitude, their work. You are regulating. So first of all, you guide them how to perform work. Direct what actions they should perform, how work they should be performed by them. That is called direction. Then you control and monitor them. You ask the auditors that give reports how you are working, how you are ensuring compliance with what direction we are giving you. Are you doing compliance with that? Okay, you report us. We will monitor you. And then if they do not monitor, that is penalized. Penalty is there. So the point is regulation. So audit is regulated. The profession, auditor work is regulated. First of all, why to regulate it? Why to regulate? A genuine question is why to regulate audit and auditor? This is a genuine question, 100% genuine. The answer is yes. That since there are so many parties, so many people who are trusting the auditor's work, auditor's report is relied upon by so many parties. Authorities are relying on it, tax authorities, investors, lenders, for their own respective use. So that's why the work of auditor and auditor's report is very, very, very much important. Because if auditor's work is not appropriate, so the report given by auditor will not be appropriate. And all stakeholders who are ultimately relying auditor's report, they will be misguided. That's why regulation of audit is mandatory. Now, let us proceed further. Now, let us proceed further. The next point is the next point is students, How to regulate audit? How auditor is regulated? The regulation sources. How auditor is regulated? A genuine question. So the point is, the first of all, auditor is regulated by national laws and regulations. So national laws and regulations, they tell auditor. National laws and regulations, they decide that how to, yes, eligibility criteria for audit. That if you want to become an auditor, if you want to become an auditor, what is the way? What education you should have? What education you should have? What should be the experience, trainings you should have? So that is basically, I'm sorry, eligibility criteria, full training, experience, ethical codes you need to comply with. So this is the national laws and regulation they tell. The second thing, which is about regulations, they tell how auditor needs to be appointed, appointment and removal, and sometimes rights and liabilities of auditor as well. They tell national laws and regulation guide. Now the point is, when we talk about appointment and removal and rights and liability, we will talk about it one by one. Come to the notes. I have shared with you here. I will upload on the portal as well today, just after the class. Once again, I can send, some people join a bit late, so that they can have this volume here. So the point is, national laws and regulations, we talk about appointment. Remember, the right to appoint auditor is that of shareholders. It is their right. They can appoint auditor, no one else. And the second thing, for example, two cases. The one case is, if shareholders don't appoint, means they don't utilize their right to appoint auditor, then who appoints? Then it is appointed by, auditor is appointed by, then by directors. And directors of company then can appoint. Yes, there is another case. Another case when auditor can be appointed by directors. So first of all, this is the first case when director can appoint. And second case when director can appoint auditor is that when the company is newly formed. So first auditor, the auditor which is appointed in the first year operation of company, that is appointed by directors. That is appointed by. Yes. Next point.
The next point is, so directors can appoint, shareholder can appoint. One, two, and now come the third. When both above parties, they do not appoint, then it is auditor is appointed by Secretary of State, Home Department, or something. Maybe may have different name from the country to country. Secretary of State, authority with some government department. Okay, so then it goes with them. They can do that. So yes, appointment of auditor. Here it is. Okay. Yes, if to fill a casual vacancy, sometime auditor passes away. So casual vacancy is there. Or something accident happens, auditor is unable to perform work. So three cases when director appoint. Any period it is right of shareholder, and when if they don't appoint, then yes. Very important point. At end of each year, I got appointed as auditor for a company in 2024. Now the next year audit, I have done audit 24. Next audit is that of 25. So I will not be automatically reappointed for 2025. I will not be automatic. I need to offer myself that I am available if you want me to work as. So they offer themselves at AGM, then shareholder vote them, select them. Reappointment is not automatic. Very important point. So he is generally fixed by whoever makes the appointment. Okay. Now, next point. Removal of auditor. Now, removal, basically leaving company as auditor. Auditor can leave the company in three ways. One thing is at year end, when audit work is complete, I have given audit report. Now I don't want to be reappointed as auditor next year. I don't want to be. So I simply tell them that sorry, I have commitment. I have this logical reason with the statement of circumstances. But sorry, please, I cannot become next year auditor. You can go and hire someone else. Okay, done? No issue at all. These two are the issues basically. That when you resign as auditor, you don't give report during the year you are doing. Auditor is sorry, I cannot complete work, I'm going. That may be due to any legal matter, some issue, or some if the company is not providing auditor the circumstances and access to the record which is required for audit, they do not provide. So when they do, so I cannot complete work, I will say goodbye. The second is forced removal. Then when I am removed from the audit of a company, I mean auditor, not me. Okay. When auditor is removed, shareholders call a meeting. And in that meeting, they pass a resolution that we are going to remove this person before end of year. And this is very, dangerous circumstances. So, shareholders meeting is called, they pass a resolution. Auditor is also given the notice of that meeting. And remember, very important point, directors cannot remove auditor. They need to call, yes, shareholders meeting, by simple majority, more than, this is also called ordinary resolution, more than 50% votes, that remove this person. We don't want him to work over here. Remove this person. So simple majority. An auditor should also be given the notice of the meeting. They can come and they say, okay, we are going to be removed. This is our version. Listen to us. You are removing us for a reason. Okay, this is your version. But what we think, what we say, listen that as well. Okay? Now, so the point is, statement of circumstances they can submit. They can call meeting, even they can request. If the company is not calling a meeting, they can call and explain. If auditor resigns or is removed, that must be, they must notify ACCA. Now, so students, the first resignation and removal is done. Now, come to the rights and responsibilities of audit. Now, you tell me one thing. I ask you one thing. Based on the last lecture, what is the role of auditor or responsibility of auditor? What you discussed with me and I discussed with you in the last class. Tell me, what is the role of auditor? Tell me, please. What is the role of auditor? These 2 points, they are valid. Both points I wanted you to write, you have written. I appreciate that. The first is examination of financial statements. First thing. And the second is to report on financial statements. Now, so the next point is, so that is the main role, overriding role. And in order to perform this duty, in order to perform this role, what auditor has to do? In order to perform this duty, there are some part and parcel of performing this role. For example, if I say you have to prepare for AA exam and pass it, what is the part and parcel? You will cover the whole syllabus conceptually. You will practice OTQs. You will practice constructive response question. Do marking of your answer. Part and parcel. If you say, I'm not doing 2-3 things out of these, but I'm going to prepare, it means you are saying wrong. Preparation for exam means something which are some roles which are part and parcel of it. Now, so same is the case. So duty of auditor to form an opinion. And issue an audit report. A student has asked a question about the topic which I have covered before. Now listen, please. I would appreciate if you open your mic and ask a question instantly about the topic we just covered. Means before we move to the next topic. Okay. So when you are typing the question, actually, it happens that we have moved to the next one and coming back to the now referring the previous one. I have no issue in doing, but it doesn't, we get distracted from the next topic. But I will answer your question now. Please do open your mic, talk to me, ask question whenever you need to. The question is, director can appoint and fix the payment of, why they can't remove? The question answer is, directors can appoint only in rare circumstances, exceptional circumstances, not normally. Normally, it is the right of shareholders. That's because shareholders are the, if you remember the assurance engagement, the topic. So shareholders are the intended user of audit report. Remember that? So basically, auditor is appointed for mainly for their benefit, not for the benefit of directors. Remember that? So basically, auditor is for shareholders, not for directors. So directors should not have any right to disturb auditor, are acting as a threat to remove them. Otherwise, auditor will not be independent, will not be able to perform work properly. They cannot give report against directors. Got it? Is your answer is, did you get the answer to your question, dear? Gabriel, please ask, tell me. Good. Now, so I was telling you, this is the overall duty, and these are duties subsidiary to it. For example, auditor has to check, duty to check adequate accounting record has been kept. Adequate. Now, what is meant by adequate? How generic word it is? Generic word. You may think, Mr. Hamzah, what is meant by adequate? Adequate means whatever is required by relevant law and standards where the company is operating. Okay? Record, accounting, and companies in compliance with other laws as well. Directors' emoluments, benefits. The benefits of directors, they have been properly disclosed. Accounts are in agreement with underlying record. Accounts are in agreement with underlying record. Means, if you know that financial statements, they are extracted from accounts, books of accounts, they are closed at year end. And we extract financial statements from that. They're closed and financial statements are formed. And accounts are prepared through source documents. What they are? Invoices, different type of invoices, vouchers, no dispatch notes, received notes. So they are now. I hope it is clear to you people. Any question you can ask before I proceed. So, auditor has to check, first of all, financial statements have been correctly extracted. Correctly extracted from accounts. Then he has to check accounts are backed by account some record, source documents. He has to check that as well. Now, the next point. The next point is, and company may have multiple branches. The company may have multiple branches. An auditor needs to make sure that even if we do not visit all the branches, so other branches which have not been visited, their returns are received and checked by auditor. So you see here duties of auditor. And then in order to perform these duties, I have something in my responsibility. I must have rights as well, so that I can perform my duties well. Now, so statutory rights. So the rights of auditors, that auditor can right to access to all record of company, books of accounts, vouchers, documents, right to obtain explanation from all officers of company relevant to audit, explanation, right to attend general meeting of shareholders, right to speak on the meetings, right to receive all notices and resolutions copies. So we are talking about regulation of audit. So a few things we talked about, the national laws and regulations. And then came here IFAC, International Federation of Accountants. International Federation of Accountants. So IFAC has, what is IFAC? International Federation of Accountants. International Federation of Accountants, IFAC. IFAC is a global body of accountants where more than 140 bodies, accountancy bodies, are member of it. Just like ACCA, ICAW, CIMA, and so on. They are member of IFAC. IFAC governing body. It works for the betterment of the profession. Now, to the point is, IFAC has a subcommittee that is called IAASB, International Audit and Assurance Standards Board. International Audit and Assurance Standards Board. IFAC has this subcommittee. So what does it do? This subcommittee issues ISAs, International Standards on Auditing. International Standards on Auditing. These are the guidelines to perform audits. International Standards on Auditing. It issues, revises. It issues a multiple other standards as well. For example, ISQM, International Standards on Quality Management. Quality management. So these are the standards which are there to ensure quality of audit. Now, the second is, so again, auditor is being directed and controlled. Auditor is being directed and controlled. Now, next point. The next point is IESBA. What is IESBA? International Ethics Standards Board for Accountants. International Ethics Standard Board for Accountants. What does it do? International Ethics Standard Board basically it issues and revises codes of ethics. You may have studied ACCA codes of ethics before. You may have studied ACCA codes of ethics before. Now, the next point is, so code of ethics, which auditor has to comply with. Now, the next point is, so you see here, auditor is being directed and controlled. The third source to regulate audit, regulation of audit, that is audit committee. Audit committee. What is audit committee? Audit committee, we know that it is subcommittee of board of directors of company. So how it regulates auditor? External auditor, which we call. So audit committee actually, it monitors independence of auditor and ensures auditor has access to all record of company. And ensures auditor has access to all record of company. You have any confusion? Feel free to ask. Next. So the next is, so regulation of audit we are talking about. So removal of auditor is done. Okay. Development of IAASB standards. How standards are made. How standards are created. IEASB standards. Student, the point is IASB, just like IFRS, you have studied. Accounting, international accounting standard. These are ISAs, international standards on auditing. These are accounting standards. These are auditing standards. So how auditing standards are made? The process which is used for that is called due process. Due process. And the project, for example, they say this is the currently lacking in the audit process or audit report. So let us improve it. The new guidances are here. Okay. So the process which is used for that purpose is called due process. Is called due process. And the process is start. For example, there is a need to form, or to make a new standard, a revised current standard, auditing standard. So the 2, 3, 4%, whatever they think fit, they make a task force, a committee. A project is proposed, and if approved, it is assigned to a task force that go research on it and bring with the solution and revised thing. So they go and they bring that. A project task force, they develop the suggested solution. Exposure draft is formed. Now, so exposure draft, they bring and prepare that, and they present this is the solution. And that suggested solution, proposed standard, is published on ACCA's website. That is published on ACCA's website. And people are told that we are going to launch this. Do you have any objection, any suggestion on this revised standard? And minimum 120 days it is put over there. So their comments are received, and then comments are considered at open meeting of the IAASB. Comments are considered there. And then afterwards, this is revised as necessary. Exposure draft is approved at the meeting of IAASB members then. Yes? Now, it is complete. Now, limitations of audit, the next topic. Limitations. Students, during the audit, at a various stage, we say auditor will decide this thing by judgment. Now, so auditing is subjective. At various stages of audit, judgment has to be made. An auditor performs sample-based testing. Not all financial statement items checked. Sample-based testing. And of course, that is the limitation. And audit report. Audit is financial year end is 30th June. Audit report is coming in end of September. Normally, 2-3 months it takes. Longer the time it takes, its usefulness is decreased. Its usefulness is decreased. And then audit report has a certain format we will study. A certain format. And that report is issued in that specific formats and words we will study. And that format, with the passage of time, after 4-5 years, means 5-6 years before it was revised, that okay, the previous was not good, now this is improvement. So that may not cover all the relevant aspects because standardized format. And very important limitation. Now, audit evidence is sometimes persuasive rather than conclusive. Tells what is probable, not means. We are checking some transactions of which actually occurred and recorded in September 2024. And now we are checking being audited in June 2025, 7, 8, 9 months after. So when you are trying to verify items throughout the year which occurred, you may not actually, possibility is there. You say, okay, this one invoice is here, one order is here. Okay, there is probability, high probability, yes, this transaction actually occurred. Okay, so, but not certain. So you have to make decision based on balance of probability. Next, so limitations of audit in front of you. Students, now we will proceed towards ACCA Study Hub, and we will talk about a few objective test questions. We will do some practice. Let me open and share ACCA Study Hub in front of you. Just a minute. I am going to share my screen. I'm opening the ACCA Study Hub. Yes. So OT revision cases. So starting with audit and assurance engagements, Nadas company. Yes, please. This first objective test question. Yes, please. Need answers from you. To obtain reasonable assurance about whether the financial statements as a whole are free from, yes, first one. This is the overall objective. And to report, to form opinion and to report A and B. C or D are subsidiary to it. Okay, main objectives are these two. The first two. All other word, the subsidiary object of to this. Next, tell me. Yes, please. Which of the following statement, students, you should respond? Only one person is responding. This is not fair. If you are present in the last class, you should solve it. Maximum your answer will be wrong. You should try. Not fair. Now you see here, A, B, C, D. A, B, C seems to be same. No, they are not same. Agency is one is managing on the behalf of the other. This one, C. This is agent responsibility, not concept of agency. This is stewardship. C is the answer. Next. Tell me. More people, more answer, please. A, B, D, F. Exactly. Subject matter, report, criteria, evidence, crest. C, C, R, E, yes, S. T is not here only. Fourth he asked for. Done. Next. Please. Very good. Students, read from here and read this. Everyone. Try to understand question. Now, students, the point is, they say an assistant who has been assigned to help you has expressed some uncertainty over the evaluation criteria in assurance engagements. Which of the you have been given an example of evaluation criteria? These are criterias. So what they say that what will be the relevant subject matter for OECD is the corporate governance. Governance, money laundering, anti-corruption, IFRS, financial statements. IFRS is criteria for financial statements. Commonly used definition of KPIs, performance KPIs. It is for operational targets. So KPIs are criteria for operational targets. Next. Which two of the following statements comparing a reasonable assurance with a limited assurance are true? Tell me. Tell me, please. Understanding of the question is very important. Yes. Which two of the following statement comparing engagement risk? No, nothing like that. Less evidence, yes. Less evidence. Less evidence is required for that. Limited assurance. Understanding of inventory, not necessary. For limited assurance, limited work is performed. I will tell you which work is performed for limited assurance. Okay? Not detailed understanding required for limited assurance. For limited assurance, detailed understanding is not required. Exactly. A conclusion is in positive form for reasonable and negative form for limited. Now, so this is correct. Yes, as well. So it is done. Next, OTQ. Yes, please. Read it carefully. An assurance agreement can provide limited assurance or reasonable assurance. Indicate by clicking on relevant boxes which of the statement is true of limited assurance, reasonable assurance, or both. Audit is example of reasonable assurance. It provides a lower level, limited. Judgment is required to determine appropriate procedure required to both. Both. Judgment is required. And a negative form of conclusion. Yes. Here we go. Next. Which two of the following tests would Doge and company carry out as part of limited assurance review? Yes, student, it has come. I'm telling you. In the limited assurance, auditor perform limited test. Two tests are performed normally. The one is called inquiry, and the second is called analytical procedures. Inquiry and analytical procedures. Two tests are performed. Inquiry and analytical procedure. These tests of control, extensive tests are not performed in the limited assurance. Remember, in the limited assurance or review engagement, only two tests are performed. Inquiry and analytical procedures. Done. Note down this point with yourself. Next. The next point is the IASB's framework for assurance engagement requires certain elements to be present in every assurance engagement. which of the elements required by the framework is not present in the case of trim transport company. Trim transport company. Read it and tell which element of assurance engagement is not present. Correct. Remember that. Correct. C. R. E. S. T. Criteria. Yes. The board of directors set KPIs, criteria. And they are, for the year ended, the board has asked Doge to perform assessment of performance and to report. This is the practitioner. The board will assess, yes, will provide access to books and account, does not provide. So you see here, KPIs, performance report is the subject matter. Performance is the subject matter. Sorry. Subject matter, KPIs, criteria. They need to perform and report, provide a report. Report is there, evidence is there. They need to obtain evidence. There is practitioner. There is responsible party. Where is the intended user? Intended user is not there. So two parties are there. There is no three parties. So three parties. This is missing. Three-party relationship. Okay. Now, internal audit. We will not do this. We have not studied this topic. Yes, tell me. This is whole. Read it and tell me the answer. Be quick. The inherent limitation is here. Exactly. D. I appreciate. I appreciate. Done. Next. Third. Kamari. Yes, please. The first question. Yeah, identify by clicking relevant boxes which each statement about audit and assurance is true or false. Next. So audit can always provide reasonable assurance. Yes. Audit engagement is about reasonable assurance. No, none else. False. It means there are no material misstatements. Small misstatements can be there. Non-audit engagements, no. There are compilation engagement. There are agreed upon procedures. So if false, no false. 5 elements. Yes. Next. Which of the following elements about the non-audit services that the director of Kimari company has asked Thira and company to provide is true? Yes, please. Kimari, a manufacturing company, has just reached the size of which local legislation required to have an external auditor. You work for Thira and director have asked your firm to consider appointment as external auditor and also provide some non-audit services as well. To fund its next growth phase, the directors are applying for a bank loan and have prepared financial forecast to support. But the application, they have asked if Thira can carry out an additional assurance engagement to review the financial state forecast they have produced. Now, so the forecast, as the company is growing, it is also currently establishing internal audit. The director of Kimari has asked Thira to provide the company internal audit services. They have outlined that one of the first tasks to complete to be review the procedure arising sale order and process of sale invoices. As a new system is being used, it has identified the procedure in this area may be improved. Thera cannot accept. Limited assurance will be provided for review. Why they cannot? They can accept with the safeguards. Okay. In the forecast, intended user, they are not shareholder. That is a bank. Bank will be using financial forecast and it is basically review engagement. No, not under ISAs. Review engagement is different or internal audit is different now. So B. So next. Outsourcing internal audit. We have not done this topic. Again, we have not done it. not done it. Okay. So students, we are going to take a 5 minutes break. After 5 minutes, I'm going to start next topic, that is corporate governance, very important from exam point of view. So we will be meeting in 5 minutes time and studying corporate governance. See you. Yes, students, now we are going to discuss a chapter. Let me link my iPad. Corporate governance. Corporate governance. Corporate means company. Governance, administration, direction. So, corporate governance means that the company, good corporate governance means that the companies should be managed, directed, run in the best interest of their stakeholders. So, corporate governance, the concept is the companies should be directed, controlled companies should be in the best interest of their stakeholders. This is the concept. So basically, this concept developed over time. Initially, it was a reactionary. The concept reactionary to the frauds which actually occurred in the corporate world. So corporate governance is basically, since governance, direction and control of a company is in the hand of board of directors. So corporate governance is directly linked to the board of directors, its composition, its roles, its subcommittees, and their roles. How they should actually, this is actually corporate governance talks about that. And of course, it talks about the auditor as well a bit, and their relationship with directors. So basically, corporate governance, best practices were introduced about these things. Best practices. With the passage of time, they have evolved. Corporate scandal occurred, investigations were made, and they came up with suggestions. The best practices to be followed to repeat, to see the repeat of the same frauds in the future. So hence, board of directors and best practices when we talk about, come here. So corporate governance. These best practices are voluntary codes that if a company wants to follow this is company's choice. It is not mandatory. That how the board should have composition of the board, the responsibilities, reporting requirement means these are basically rules, but best practices are something to be done by the company, and that has a cost for the business. But it is a voluntary codes, voluntary, so that these are flexible, not mandatory. So companies can pick and choose as per their size. These requirements, best practices should not become a burden on small companies, small businesses. It should not become. And yes, so companies can flexibly apply to their own circumstances. But yes, there is a downside as well. What is downside? That when there is no compulsion to follow, when it is not mandatory to follow, what will happen? No one will follow. This is the point. This is a problem. Now, let us proceed further. So, come to the notes. So, I have discussed with you the corporate governance for voluntary codes. So, we are starting the best practices discussion. Students, in past exam, last 2 years, 2 or 3 times a scenario has been tested from it. OTQs have been tested from it. So, that's why you need to prepare it very carefully. So, corporate governance best practices we are going to discuss. First of all, the first best practices, company should be headed by a balanced board. Balanced board. Now, so balanced board means 3 things. One, the board should be a balance in skills and experience. Whatever is required to run the company successfully. I'm sorry. The board should have that mix of skills and experiences. Must. The second is the board should be from a diverse background. The board members should have different experiences of the life. They should not all be having the same experience, because when they will have the same experience, same exposure, they cannot bring anything new to the company. Company will be stuck. No new ideas. Third, the board should be balanced in number of executive directors. They should equal to number of independent non-executive directors. I will talk about it in detail. Now, executive directors. So, executive directors, who they are? They are full-time employee of company. You hear director production, director marketing, director sales. Okay, they are all employees of company. They get salary. They run daily operations. And their salary should have two components. One is basic salary, the other is performance related pay. It should be smaller part, it should be the bigger part of salary. Next means performance related bonuses so that they perform. They achieve targets to get salaries. Otherwise, if basic salary is high, they need not to do anything. So non-executive directors, they actually have time commitment and responsibilities to oversee normally EDs, executive directors. They bring fresh perspective. Now, their role is to provide deep, deeper insights, guidance, mentoring a type of, and monitoring as well. Monitoring as well in the board. Next. So, yes, they do not involve in daily operations. No, they are part of committees. They become part of board committees to discharge their roles and are paid fixed fee based on time, commitment, and responsibilities they perform. Fixed, no performance based. No performance based payment. Remember that. Next. Let us proceed further. Students, second, corporate governance best practices. The company must have CEO and chairman, two different persons. CEO and chairman, two different persons. CEO is one of executive directors. He is a head of operation. He is the king. Chairman of board. He chairs board meetings. One, and holds CEO accountable there for decisions made. Very important. Now, students, one thing we missed here, we said number of EDs is equal to number of NEDs. 5 EDs, 5 NEDs. 10 EDs, 10 NEDs. Balance board. But these independent NED, some non-executive directors may be there, but may not be independent. Come here. There is a criteria for independence of NEDs, which you need to memorize. Independent. So if an NED was employee of company since last 5 years, he is not independent. Employee of company or group, or have business relationship material, partner, shareholder, director, or employee of a company, through them, any business relationship which is material, business relationship 3 years and 5 years as employee, he is not independent. He can become non-executive directors of a company, but when we count 5 independent entity, he will not be counted, or she will not be counted. Who receive performance related pay is not independent. Who has close family ties with senior management of company. Who has served, and he was independent entity, but served 9 years at the board as independent. Now, after 9 years, he will not be independent. And these two I will explain, cannot hold cross directorship. Listen, Mr. A and Mr. B. Sorry, Mr. B. Both are executive directors. He is at Fear Inc. and he is Hope PLC, at Hope PLC. Okay? Hope PLC, Mr. B is executive director and he is here, executive directors. Mr. B is working as non-executive director in Fear. ED here, 2 roles. And Mr. A is working as a non-executive director here. This is cross. Now you see here, what happened? In Fear Inc., he is a non-executive director and he is reviewing the performance of Mr. A. Here, Mr. A is reviewing the performance of Mr. B. Both are reviewing each other's performance. They will both favor each other. This is called cross directorship. So they are not independent entities, both in their companies. Cross directorship is clear, I think. Represent a significant. I go and I buy shares in Profit PLC. The company is Profit PLC. I buy shares 15% shares, and I ask them, okay, I'm going to buy. In my contract, I can appoint 2 persons to watch my interest in this company, as I want to appoint non-executive directors. They will watch my interest. So these 2 persons, which I appoint as a part of this contract, at the board of this company, they go attend board meetings. They are NEDs, but they are not independent. They are representing me only, significant shareholders. They are not protecting the interest of other shareholders. So the person who represents a significant shareholder is not independent. In an exam, you may find a scenario. You may need to check whether the NED is independent or not. You should memorize this criteria and understand as well. Now, corporate governance best practices we are discussing. Okay, board committees. Come here. Board committees. Board has normally 4 subcommittees. Audit committee, remuneration committee, nomination committee, and risk committee. Okay. Now, composition. Audit committee has entirely non-executive directors which are independent. Non-executive directors. No ED can sit here. Entirely NEDs. Again, here as well. Here, majority NEDs. Here, majority means ED can sit here. ED can sit here. Now, so you see here, entirely NEDs, 100%, 100%. No ED can sit in these 2 committees. Now listen. One more thing. Each committee has one chairman. Subcommittee has their own chairman who chair the committees. Remember, in the remuneration committee, you can note down chairman of company can sit on it in this committee. Overall chairman of company, chairman of board. But can't be its chair as well. Can't chair this committee. Its chair will be some different person. Remuneration committee. Nomination committee. What are its roles? Its roles are nominate new directors. Some director leave. It works on balance of board. The board balance we talked. It works on that. Board is balanced. Works on induction of new directors and development of directors as well. The directors have updated knowledge, developed. A new director join the company, gets proper induction, proper information, so that they can become, they feel welcomed. They become productive as early as possible. Yes. Now, the next point is, students, one more thing about nomination committee, very important. Chairman of company, overall chairman, is chair of this committee as well. He cannot become chair of remuneration committee, but he is chair of this committee. Okay? Now, so remuneration committee, what does it do? It decides remuneration policies. It decides remuneration policies of company overall. Enough remuneration to attract, to retain, especially for executive directors, EDs. Their salaries they decide. Overall compensation level in the company they decide. Chairman, what will get, they decide. Chairman of company. Yes, very important role. And there is a rule regarding remuneration. Note down, no director should be involved in deciding one's own remuneration. One's own remuneration. Next. The next point is audit committee. Entirely NAD. At least 3 members should have. One must be finance expert. Now come to the notes. Roles of remuneration committee. Very important. Okay, you will read. I have explained already. Yes, it should also have minimum 3 entities, 3 members. The next is audit committee roles. They review integrity of financial statements are prepared by finance department, but financial statements are prepared well. Their monitoring is done by integrity monitoring by the audit committee. They review controls of company as well. They monitor the internal audit function. Some I have already told you. They monitor external auditor independence. Okay, so read it as well. Now, come here. Corporate governance best practices. I have already explained. Yes, all directors should be submitted for a regular interval for re-election. At the end of year, director's performance is subject to review by shareholders. So do you elect them for the next year? Board should give their report that what we have done for the company, how we have maintained control and risk management. Okay, So I have already explained all these things, best practice, you will go through it. Now the last topic for today, it is almost complete. You need to come for in the next class prepared. Corporate governance topic should be very well prepared. We have to solve scenario on it. Now, the last topic, that is OECD Principles of Corporate Governance. OECD. There was an OTQ as well, objective test question. We did. Listen, focus. Corporate governance best practices we have learned. They are for the bigger companies, for the developed countries. For small countries, developing countries, OECD has told that you can develop your own corporate governance principles, but they should focus these 6 aspects. They should ensure effective corporate governance. It means objectives of corporate governance are achieved. To ensure proper direction and control of company in the best interest of shareholders. Rights of shareholders should be protected. When you are making your rules of corporate governance, make sure all shareholders are treated equally. Minority shareholders and majority shareholders, they should be treated equally, should be protected equally. Other stakeholders in the company, employees, for example, environment, that should be addressed as well. Disclosure and transparency should be encouraged. The company disclose maximum information, and board is ultimately responsible for corporate governance. So your whatever rules you form, they should surround these 6 areas. You need to memorize this. When corporate governance is complete, in the next class, you have got the notes, memorize it well. We will be doing internal audit. We will be doing scenarios on corporate governance, and I will be telling you how to write answer. And then we will be talking about, if we have time, that is the acceptance of audit. Audit cycle will be started. Most likely it will be done. Acceptance of audit as well. So please prepare well, whatever we have covered. Okay, any question, anyone? Please ask the question. Anyone, any question, please? All right, thank you for joining. Most probably today is the last class for means, which is some people are on trial, other people are enrolled. So we will be meeting in the next class. Please get enrolled. And for enrollment details, you can contact this WhatsApp number. Okay. Send them text. They will respond you, of course, by tomorrow now, I think, because right now it is off time. Okay. Here, late night. So see you. God bless you. Take care. Goodbye.